Good morning, everybody. Kendra here, your current president, and I have the pleasure of introducing Dr. Lawrence Yun. Good morning, Dr. Yun. Thank you so much for being here, and thank you all the members for being here as well. So we're going to go ahead and get this started. We're so excited to welcome Dr. Lawrence Yun, Chief Economist of the National Association of Realtors. He received his undergraduate from Purdue and went on to receive his PhD from the University of Maryland. His impressive resume goes beyond keeping all 1.5 million and growing realtors updated on the ever-changing market trends. He has been featured on a number of national economic panels, speaks regularly at real estate conferences throughout the US, has been featured on C-SPAN's Wall Street Journal, and has testified in front of Congress. And that is just a snapshot of his accomplishments. So please give a warm QCAR welcome to Dr. Lawrence Yun. Take it away, Doctor.
Great. Thank you, President Kendra, for inviting me to share some of my thoughts in this transitioning real estate market. It is transitioning because mortgage rate popping from 3% of last 2 years to now close to 6%. These are quite a large sudden changes on the lifeblood of real estate. Most consumers need to take out a mortgage, and this change is quite substantial and so quick in terms of magnitude. So what does that mean? The other part is there's more talk about economic recession. And I would place probability now, possibly even close to 50% chance of an economic recession. But this recession will be somewhat different from past recession in a sense that we have this record low unemployment rate. Job openings are quite plentiful. There's help wanted sign. You walk down any Main Street America and there's help wanted sign. But still in some industry, they're laying off people. Mortgage industry, certainly refinancing died off. So how does all this will play out? So let me put the PowerPoint slide and give you my best estimate as to what you should anticipate in the upcoming year or remainder of the year and as we go into next year in 2023. So I'm going to put the PowerPoint onto the screen. Bear with me. Okay, so there we are. So let's start from here. So first, let's just quickly review of the quite an exceptional performance in the housing market. The housing market really boomed during the COVID environment. 2020, 2021 really boomed, bursting out from the sort of decent figures pre-COVID. So pre-COVID, it was respectable, decent. And then when the COVID hit, I guess one silver lining, because no one wants to have a repeat of COVID, is that the Federal Reserve lowered the interest rate to the lowest possible. And consequently, low interest rate really brought buyers into the market, and home sales essentially climbed up to 15-year high. It didn't go back to 2005 levels, and good thing, because 2005 was an artificial high. Subprime lending, those risky mortgages with funny terms, where I think some of the initial payments were even below the amortizing rate amount. That is to say, you make $300 monthly payment and your mortgage balance increased the following month. No income documentation, just fill in the blank. So very risky situation. And then the housing market suffered from that with a foreclosure crisis. But as you can see from the chart, from the low point in 2010, steady climb, and then really a boom in the past 2 years. Home prices in the meantime, these are at the national level, and the many local market will follow very, very similar pattern in terms of the 2005 artificial boom, foreclosure crisis, some steadiness, and then home sales bursting out in the COVID environment. The home prices, again, the national median price condition hit an all-time high. In 2020, and then another high in 2021, and it looks like we're going to hit another high in 2022. So home prices in the meantime continue to rise, indicating that people who are buying home for the long term, they will do quite well because this is a middle class way to build wealth. Stock market is very wobbly. I know some of you are checking the stock market and saying, oh, look at my portfolio. But most wealth for middle-class Americans are tied to housing. So at least if people were homeowners, or if you have a second investment property, you are at least feeling some degree of stability or actually better off condition because of the price increases. So very nice movement on the prices. National median home price surpassed $400,000 in our most recent monthly data. So, upgrading it to 2022. Now in your Quad City area, it's about half the national average. So median price, about 200,000 or even slightly under, which is hinting at is an affordability. And also when I mentioned about this transitioning market, we are seeing a greatest transition from higher mortgage rate in expensive areas. I live in Washington, D.C. area. So the office is in Washington, D.C. I live in Arlington, Virginia. Quite a steep decline in sales activity because expensive area is really getting hit from high mortgage rates. Same situation in Boston, Seattle, expensive area, you are seeing that. Less impact in affordable regions. So perhaps one benefit of being in the Midwest, middle of the country, is that homes are affordable and changes in mortgage rates is not welcome, but the impact is less severe given that it is still affordable in the Midwest markets. Let's look at the Quad City regions, or specifically what the government called the metropolitan areas of Davenport, Moline, and Rock Island. So covering Iowa, Illinois border, the area. And the prices have been generally very steady, 4 or 5% a year growth. And then during the foreclosure crisis, essentially no growth in prices. Chicago area suffered price decline during the foreclosure crisis, but not in your area. You did not really experience any deep price decline. You just had no price growth during the foreclosure crisis. And then when the market turned for the better, normal 3-4% year appreciation. Then COVID, and here comes the price boost of better than 10% increase. So real strong boost in home prices. One thing you want to do, because your future clients are often your past clients. So one thing you should be doing is recontacting all the consumers you served over the past 2 years, shake their hand, pat them on the back to say, you made a great decision, you got the price gain, you locked in at those low interest rates, 3% mortgage rates. So those are a great decision for the consumers, your clients over the past 2 years. But the question is, what happens to the future consumers or first-time buyers who want to buy today in this higher interest rate environment? Here's the mortgage rate move. Blue line is the average 30-year fixed rate mortgage. And as you can see, it's quite a sharp upturn from beginning of this year. Even December of last year, 3% mortgage rates, but today essentially banging on the door for 6%. The red line is not for you and me. It's not for your clients. It's something called Fed funds rate. It's the interest rate that the Federal Reserve in Washington controls. So Federal Reserve, when they raise interest rate, it becomes a headline news. You see it on the evening news to say Federal Reserve raised interest rates, things like this. But as you can see from the chart, red line and the blue line do not move one-to-one relationship. Mortgage rates, in fact, could be sometimes fairly independent. Look at the middle of the graph. Red line goes up, goes down, goes up, goes down, yet the blue line barely moves. So it's possible that the mortgage rate could be unhinged, unconnected to what the Washington, D.C. does. But look what's happening today. Red line has increased. Federal Reserve has been raising interest rate. I think 2 weeks ago or 3 weeks ago, it was a 0.75% move, large move in one go. In a one swing, they decide to raise interest rate by 75 basis points. Sorry for the lingo, but that's a large increase in a one go. But look how the blue line has responded, far larger than the red line has indicated. So what this is telling me is the following. Federal Reserve is saying they will raise interest rate more rounds. Next month, in September, probably in November again, and maybe even in the early months of next year. Federal Reserve has clearly communicated that they will be raising interest rates. So the blue line is in a sense pricing in. They're expecting this will occur in the future months. So they say, okay, the bond market is responding, and they essentially has incorporated this changes in future action by the Federal Reserve. Another way to put it from your everyday situation is maybe the mortgage rate is topping out, because even as the Federal Reserve raises interest rate in the upcoming months, mortgage rate may not move all that much. It may move a little higher, or it may even move a little lower. It's already priced in what the Federal Reserve will be doing in the upcoming months. So perhaps 6% mortgage rates is tops, 7%, is it possible? Well, anything is possible, but I think it's unlikely. 7% is unlikely, and even 5.5% is possible. Maybe there will be some retreat in mortgage rates, even as the Federal Reserve raises interest rates. So perhaps most of the changes in mortgage rates have already occurred, knowing what the Federal Reserve will be doing in the upcoming months. We all have mortgage calculator, and we can easily run the numbers, but sometimes it's worthwhile to do it together. So let's just do it together. So this is on a $200,000 mortgage. 1 year ago, mortgage rate was at 3%. So $200,000 loan, you punch into the mortgage calculator, and here are the numbers. $843 per month, principal and interest. So that is your client last year. Then it goes up to 4%, 5%, 6%. You see how the monthly payment is changing. By the way, ordinary, everyday Americans, they are aware of the mortgage calculator, but they don't punch in the numbers. So when they look at the mortgage rate having risen, they think, okay, mortgage rate increase. I know the grocery bill is expensive, gasoline prices is expensive. My monthly payment will be expensive as well. So they just think in just generality. They're not happy about it. But once they punch into the mortgage calculator, they will be shocked at the degree of increase in monthly payment. And here is a same table that I'm going to put on the next chart. So the table on the left side is the same table that I showed you, the mortgage calculator. But on the right side, here's what I did. Prices have risen by at least 10% in Quad City. So let's assume now the person has to take out a larger loan for the same house. So the person did not buy last year, now wants to buy now. Well, home prices have increased. So the mortgage amount is now $220,000. Mortgage rate today at 5.8%. Monthly payment is $1,291 from little over $800. So you look at the monthly payment, this is a sticker shock. Same house, last year, $843, now $1,200, $91. This is quite a shock for many consumers. And consequently, even if they have the desire to buy, they simply cannot. I mean, you see on the television commercial about change your cable service or, a dish network, satellite. People, ordinary American wants to save $20 per month. But look how the mortgage payment is changing. It is a 53% increase from a year before. This is not part of the consumer price index. So when governments say there's an inflation, they're not even including this. If they were to include this, this is quite a shock for ordinary consumers who want to buy a home. So why is the Federal Reserve raising interest rate and they are announcing they will further raise interest rates? Because inflation is getting out of control. Highest inflation in 40 years. If you are age under 40, you have never seen like this. I participate in some economist forecast panel, for example, Wall Street Journal. They said, what do you think is going to happen to the economy? What do you think is going to happen to this and that? And then they ask sometimes funny questions like, how would you grade the Federal Reserve? A, B, C, D, or F? How would you grade it? And I am inclined to give an F, because what is the job of the Federal Reserve? Their job in their mandate, in their charter, is to say, control inflation. Now that the inflation is out of control, well, they didn't do their job. In one sense, one can say that. So high inflation is the reason as to why mortgage rates are rising quickly. They are raising interest rates. So we have to get this inflation under control in order for mortgage rates to stabilize or even decline. Let's look at some of the components of where the consumer prices are rising. As I mentioned, the rise in mortgage payment is not part of this consumer price index. But let's look at the components that is included. Gasoline, you all know, and it's maddening. Airfare, prices have increased because they need to use fuel. Hotel and motel, people are tired of COVID. They have postponed their vacation. Now they want to go out, but everybody wants to go out. So there's very low vacancy rate at hotels, so they're raising the fee. And also air conditioning, those are expensive. You see the electricity cost rising, food prices, go to the grocery store, rising 10%. Rents, that is included in consumer price index. And according to government, rents are rising 5% above last year. Many of you are real estate investors. You can figure out whether this is an understatement or fairly accurate. Many people, realtors that I meet with, they said this is not correct. Rents are rising much faster. There is an apartment vacancy shortage. Other part. Only part that is not rising is mass transit. So in some sense, maybe the government wants to say, don't drive so much and take the metro, at least for big cities like Chicago, Washington, D.C., New York, San Francisco. Don't drive so much. Maybe you should take a metro. Maybe that's the intent of the government. Except what's happening today is people are not riding the metro. Chicago, New York, Washington, people are not riding the metro. Why? Crime. They don't want to be involved with crime or dirtiness. So even though the metro prices have barely risen, people are not taking the metro. Instead, they are driving because they don't want to be involved in a crime. So a very strange situation right now related to consumer prices, but it's rising. So Federal Reserve is raising interest rates. So how do we get the gasoline prices to go down? Or what is the prospect of gasoline prices going down? Realtors drive more than the general population. Certainly the builders, to get all those timber delivery, other material delivery, truck drivers, you have to pay. And with high gasoline prices, it's going to make the new home construction costs much higher. So what is the prospect of gasoline prices going down? Well, let's look at some of the history, which is related to topical issue. So the first circle that you see is in the 1980s when the oil prices collapsed. When that happened, fictional television character J.R. Ewing was angry, and there was large foreclosure in the real world in the state of Texas as oil prices declined. It really hurt the oil producers. Also, in the 1980s, it led to essentially a collapse of the Soviet Union. Russia, Ukraine, they separated along with other Soviet republics because high oil prices means they can hide some of the inefficiency of communism, but with low oil prices, it simply collapsed. The second circle that you see is late 1990s, 1998 specifically, several years of price decline. What happened? Russia came to Washington to meet with US government, World Bank, IMF, on their knees, hand in hand, say, please help us. Our Russian ruble currency is collapsing, our economy is collapsing, please help us. To show how dependent Russia is to oil prices. The third circle you see is at the beginning of COVID, is so brief, is inconsequential. But look where the oil prices are today. What this means is that Putin is able to rake in the revenue. So there is an economic sanction. Putin is saying, okay, no problem. We will sell oil to China at lower prices. We will sell it to India at a lower prices. We will sell it to other South Africa at a lower prices. Or we will even sell it to smugglers, so then they can sell it to America and then they can sell it to Europe. So Putin is raking in the revenue because oil prices are high. What is the prospect, again, for oil prices to go down? And it does not look good. Because this is a drilling activity in America, shipment of drilling equipment in America. The red line is March 2020 when COVID arrived to the country. So in essence, America was drilling more before COVID. America was drilling more when the oil prices were low. Given that oil prices are high, this is an opportunity to drill more, yet America is not drilling. So as long as America does not drill, it just means oil prices will be high and Putin will rake in the revenue. Also at the same time, it means that oil-related jobs in America is suffering. We're not creating jobs here in America at the time. I know President Biden is encouraging oil prices to go down, and certainly one can encourage, but also one can bring more supply, and without more supply, it just means that oil prices will remain elevated. Now let me turn to the job market. The economy is steadily adding jobs with each passing months. So right before COVID, there were about 150 million Americans with jobs. Then COVID hit, 20 million job losses, then steady job gain. We are almost back to normal, but not quite. Now, this is a 2-year time span. Over a 2-year time span, there are high school graduates, college graduates looking for jobs. So we should actually have more jobs than what is reflected here, but we're almost getting back to normal. Here's an interesting graph, state by state comparison. Iowa, right in the middle, the first state to do the presidential election primaries or caucus, I guess a caucus in Iowa. So everyone is looking at Iowa, they can identify it. It is showing minus 1.2. Now, some of you in Quad City, Illinois, you look at across the river and it's also minus 1.2. So what does minus 1.2 mean? It means there is 1.2% fewer jobs in Iowa and Illinois compared to March 2020, pre-COVID. So compared to pre-COVID, both Iowa and Illinois is down 1.2%. Reddish color states are down, while the blue color states, they have more jobs today compared to pre-COVID. Texas, more jobs. Florida, more jobs. North Carolina, more jobs. Indiana, more jobs. So blue color states, more job compared to pre-COVID. Alaska, down because they're not drilling. Now, Texas is very diversified today, so they're not oil dependent, so they're creating jobs. But Louisiana, they're down. And North Dakota, they're down because they're not drilling. So in these states, they're not drilling. Alaska, North Dakota, Louisiana, they're down. And consequently, that implies that high oil prices are likely to be with us for some time. If we look at specifically at your metro market in terms of job, this chart is, from my perspective, looking at all the different metro in America, it is a little depressive. Because from year 2000, where in your local area, there's about 190,000 people with jobs. It went down, it went up, it went down, but no real movement. Then finally, right before COVID, the total job number in your area is essentially same as in the year 2000. So over a 20-year time span, no real job creation. Little fluctuation in between, but no real job creation over 20 years. COVID hit, massive job losses, now trying to climb out, but not yet, not yet, you're almost there. But if we look at Des Moines, it's a different story. They had about almost 300,000 jobs back then. Now there's about 380,000 jobs in Des Moines. So somehow Des Moines, the region, is doing very well, while the Quad City region is barely hanging on in terms of the job situation, which may reflect why home prices are so affordable in your area. While in Des Moines, prices are rising, a little faster than your area because of the strength in the job market. But something that may help the Quad City region, and it's the following: working from home. Let's just focus on the red line. So what the red line is showing is how many Americans are working from home full time. So before COVID, it was 9%. These are individuals who are essentially working in front of a computer. So they are, their job involves typing through front of a computer. So 9% of the people were working from home before COVID. Then once COVID hit, and a few months after, it was 54%. Today, it is 21% working full-time from home. So higher than pre-COVID. If people can work from home, then people will be wondering, why am I in San Francisco? Why don't I go to Arizona, Florida, or I grew up in Iowa. I want to go to Iowa and buy a big mansion in Iowa and not be attached to San Francisco because it's work from home. Or say somebody who's working in Chicago. They said, well, out in the Rock Island region, it is still quite a distance to commute. But if I don't have to commute every single day, maybe commuting only once per month, then certainly is feasible. This is full-time working from home. We know there's many hybrid model, which is to say, come to office 3 days a week, other 2 days work from home, or something in between. We don't know what will be the equilibrium. Many companies will do trial and error. Companies do not want to lose workers by forcing people to come to work 100% of the time. I know Elon Musk is saying to Tesla employees, office employees, come back to work 100%. I think he's saying that just because he has too many employees and he wants to see some people quit. I think that's the reason why he's doing it rather than firing people. But I think the coming back to work 100%, that will not happen. It will be some sort of hybrid. We don't know what kind of hybrid, but one can easily imagine those big cities or even people living in Des Moines, sort of medium-sized cities, to say, look, things are expensive. Maybe I want to go to eastern part of Iowa. Or say Minneapolis, Chicago. They said, no, I want to get away from the big city. And consequently, I think the affordable regions of the country could benefit from this hybrid model of work from home. Cash deals still remain a little elevated. I'm hearing that the Wall Street companies are sniffing around and just going in, buying single family rentals because there's an apartment shortage and people want to rent. And now people want to rent little larger size units and the single family unit can provide. So Wall Street players coming in all cash, trying to buy some single family properties. Now, what can people do? Because generally the sentiment that I hear from people is Wall Street, it could destroy the neighborhoods. We don't want to see Wall Street coming in. Or, we cannot restrict the free market to play is, people are following their incentives. So if people are following their incentive, how do you restrict that? One thing that we have heard from realtors, and thank you, President Kendra, because she participated in all the discussion part, president of local association, president of state association, is to come up with some kind of policy, through that communication. And one idea that we are beginning to communicate with members of Congress is that at a time when there's not sufficient inventory and Wall Street gobbling it up, is there a way to increase supply? And there are many, many mom and pop real estate investors. Maybe some real estate investors want to cash out, that is to say, sell their property, but they don't want to pay capital gains tax. So by temporarily reducing or essentially saying no capital gains tax, as long as the person sells it to the first-time buyer, we can have increased inventory at a time when Wall Street is trying to gobble it up. So we can make the criteria that mom and pop investors, if they sell it to the first-time buyer, there will not be any capital gains tax or low capital gains tax. And certainly members of Congress are listening. I mean, there are other priorities that want to move along with the, currently, given so much division in America. So maybe it's not a top priority, but we are getting some ears in Congress of, potentially providing some temporary relief for real estate investors who want to sell it to the first-time buyers. Inventory level, again, very low. So again, low capital gains tax may provide more inventory. Home builders are trying to add more construction, more supply to the market, but red line is historical average. Only this year we're getting back to average. But look at the multiple years of underproduction. This multiple years of underproduction is the reason why we have this low inventory. So what happened to the inventory? Because we have population growth, job creation, yet builders have not been building. And consequently, we have inventory shortage. So builders finally getting back up to normal, but we can add more inventory by providing that capital gains tax relief for some real estate investors who want to sell it to first-time buyers. Survey by Fannie Mae. Is it a good time to buy? Well, you can see on the chart, many people are saying, maybe not. But this is what people are expressing and not necessarily what they will do. How do I know? Well, look at the red line. That's pre-COVID and when the COVID arrived. What was Fannie Mae's survey? Well, they are saying about the same number who are saying good time to buy, even though we knew home sales surge. So home sales can move independent of what people say. So it's possible that even though people are saying it's not a good time to buy, if the property is right and the mortgage rate or affordability is there, maybe they will buy. Here's a different survey. This survey is a little older, February of 2022. The Federal Reserve wanted to take a survey of consumer expectation, knowing that mortgage rates have risen. Mortgage rate in February was about 4%. I mean, today is much higher, but 4% mortgage rate was still higher than last year. So they wanted to know what consumers were thinking. So first, regarding home prices, what do you think will happen to home prices? And consumers were saying, well, it's going to increase 5.1% over 1 year. And then after that, maybe 2% a year. Consumer mindset, this is what consumers are thinking on average. What about rents? Well, the rents are rising even faster, according to consumers. So you talk about higher interest rates, something that consumers do not like. But one thing that consumers detest even more than higher interest rate is higher rents. They don't want to pay higher rents. So rising rent or rising future rent expectation, people may say, no, I still want to buy. I remember I bought my first home at 8% mortgage rate. My parents bought their first home at 15%. We came out fine. I mean, we actually built wealth through the home ownership, even buying at higher interest rate, because you buy, prices rise, and you can always refinance when the interest rate goes down. So one can always get that benefit. So right now the consumers are saying rents will be rising, and consumers really detest rising rent. And this could motivate some people to buy home even at higher interest rates. Big question, considering everything, rising rents, mortgage rates a little higher, home price expectation, do you think buying a home is a good financial investment? And you can see by very large margin, Americans believe buying a home is a good investment rather than a bad investment. So my quarterly term forecast on home sales is that home sales expect continuous decline just because mortgage rate will shrink the pool of buyers. Let's hope inflation is under control. Inflation could actually decelerate if oil prices was to go down. Oil prices going down, let's hope that's the case, but again, we're not drilling all that much. But if inflation is under control, interest rate can go down, and maybe we don't have this pessimistic sales forecast. Prices will continue to increase because we still have housing shortage, but in terms of your business activity, expect lower sales this year compared to last year. And in fact, on an annual basis, 2020 and 2021 was quite a fantastic year. Increased unit sales, increased home prices, meaning solid increase in dollar volume. But 2022, because of higher mortgage rates, I think the sales will be about 13% lower. Prices will be up about 7%, which means that dollar revenue will be down more minimally at 6%. Then next year, maybe we surpass the job continues, mortgage rates stabilize or even decline if inflation is under control, and then things will begin to stabilize next year. And then 2024 onwards, one should anticipate some steady growth from that. So thank you very much for providing me with some time to share my thoughts with you all. Again, the big benefit in your region is that affordability. Now, maybe the lackluster job creation in your area is the reason for the affordability, but certainly you can use that affordability to attract people from Chicago, Minneapolis, or even from big cities, New York and San Francisco, where they can work from home full time. Well, they can easily buy a big mansion in Iowa, Illinois, compared to those big cities. So thank you again. Thank you very much.
Thank you very, very much, Doctor. Do you have time for questions, or are you on to your next appointment?
Let's do 2 questions.
Okay, 2 questions. Go ahead and either first come, first serve, either raise your hand or write the question in the chat box. You have answered all the world's questions. Thank you. All right, we'll just give it a couple more seconds here. Oh, we have one from Dennis there and Heather. Can you see them okay, Doctor? The questions?
Okay, so regarding the rural housing, certainly, the Department of Agriculture, the mortgage, that 0 down payment, something that we constantly advocate on the availability of it. But I think what is more critical is that we've been pushing the high-speed internet access to rural communities, because now, just like during the old days, during the Great Depression, America wanted to electrify America, to say electricity should be available for the farmers, should be available not only for the city folks, but for everyone. I think the same mindset needs to be about the internet, high-speed internet access, and certainly with a wider access to internet that makes working from home flexibility much easier, which you will be benefiting. And the final question is that, let me see here. What do you see as the greatest opportunity to increase supply? Ultimately, it's about the home builders. Home builders, I know they're facing challenges. Home builders, at the first sign of increase in interest rate, they pull back. But what the home builders will realize is that once the home is completed, by the way, let me just backtrack. Home building takes a long time, especially now with a garage door stuck in a container ship. So someone who had contracted last year to buy a new home this year, they suddenly realized that they thought mortgage rate would be 3%, now 6%, they cannot buy that. They may even lose some of their security deposit. Realtor's role is to get that security deposit back, find a legal way in some way, trying to get it back. But the builders, once the home is completed, they're selling it easily. So, the builders are panicking because of some canceled contracts, but once the home is actually completed and ready to go on the market, they can generally sell it within 2 months. So this is a fairly fast process that's occurring. So hopefully the builders understand that and continue to increase supply in order to bring more supply to the market. So thank you very much.
Awesome. Thank you so much, Dr. Yoon. On behalf of the Quad City Area Realtors, we are very thankful of your time and your expertise. So thank you again. Appreciate you. Have a great day.